How long will it take to improve your credit score? Do you remember the song from Queen, I Want It All and I Want It Now? Well, you're going to have to wait a little longer than that, but we're going to tell you the 3 quickest ways to be able to improve your credit score to put you on the path, hopefully, to being able to get to home ownership. So stay tuned to find the quickest way to improve your credit. If you watched our video on how to improve your credit score, then your next question will be, how long is it going to take? Some of that depends on your current situation, and some depends on how much effort you are willing to apply. First off, let's go through some basics. Your credit score, often referred to as your FICO score, comes from the Fair Isaac Company. They are the ones who pioneered the creation of the credit score. So we can thank them for, everybody using them to base their lending decisions and whether or not you're going to get a loan, or whether or not what your interest rate is going to be. These credit scores are used by pretty much anyone who lends money, provides credit, or even leases apartments. When we work with landlords to help them find tenants, they often require a minimum credit score for their prospective tenants. That may provide a better understanding of the creditability of that tenant for that property. But I digress. The main thing to understand is the lower the number on your FICO score, the riskier it is to lend to you. Here's the FICO ranking chart. According to FICO, who makes this available, how your FICO score is viewed and what kind of ranking you may have determines what kind of interest rate or your really loan worthiness. You can see that if your score is anything over 800, you're considered an exceptional credit risk, that getting you approved for loans should be easier. A lender will look at your credit history and say, this is a person who is trustworthy and creditworthy. This will also give you the best interest rate possible for your type of loan product. If the score is between 740 and 799, that is considered a very good credit risk. So once again, that is going to be looked upon favorably by anybody that's going to be providing you credit. If the score is between 670 and 639, you have good credit, but not great credit. This may mean that you pay a little higher rate of interest for the lending product. Whether you're borrowing money for a car or borrowing money to buy a house, your rate may be okay, but won't be the best rate. You must keep in mind that the interest rate affects your payment. The loan amount times the interest rate times the length of the loan is how your interest payment is calculated. If your FICO score is between 580 and 669, that would be considered fair credit. In many instances, you would not be able to qualify for a conventional type of mortgage. You may qualify for some type of government-backed mortgage, but may require extra work for you to provide your creditworthiness. Anything below 580 is considered poor credit and is going to be nearly impossible for you to borrow money without some type of cosigner or guarantor. If somebody decides to lend you money, they're going to charge you an interest rate that's going to be reflective of that risk they're taking, which means a significant interest rate to you. So now you understand where the ranges are for a good credit score, let's also get an understanding as well about what kind of things can impact your credit score. What kind of negative events? Because we told you about the positive things in our previous video. What are the things that hurt your credit score? Well, applying for credit or applying for credit repeatedly can have a negative effect on your score. According to the formulas used by FICO, applying for credit is going to put some dings on your credit score. Another negative is maxing out cards. If you have a certain limit on your credit card and you have taken it to that limit, that's not viewed very favorably. It gets worse when you max out a card and then do it on another one. Then take it to that limit. That will do damage to your FICO score. Another negative is closing credit card accounts. As we talked about in our previous video, credit history is a very important determiner of your past performance. So the longer you have a credit history and the more you can demonstrate that you have been a good credit risk, that's going to look favorable. If you start closing some of those long-term accounts that you have out there, you're going to make your credit history shorter instead of longer. You now limit the credit reporting bureau's visibility about your long-term credit behaviors. Another negative is late payments or default on a mortgage or loan. Late payments on a mortgage or a loan are significant hits to your credit rating because those get reported immediately, and those are viewed upon as a clear warning sign that you're having difficulty being able to make your payments. That's also going to have an impact on your credit score. What about defaulted payments? Do you have any missed payments? Not only were you late, did you just never make the payment at all? Or did you default on a loan in which you took an obligation? Let's say a credit card you took out and you just never paid it off. That will hurt your score in a big way. If you've ever had the opportunity to own a home and for whatever reason you were not able to keep current on the mortgage, at some point in time, the bank went through a foreclosure process and they took possession back from the house. It's sort of like a repo for the house, and it'll not look good upon your credit score. Bankruptcy, which you know occurs when you have bad debts that you're not able to pay, and you had to look to the court system to be able to start with a clean slate and wipe those debts clean. However, it does not wipe clean your credit score and your history of those debts or your behavior. So here's a chart that shows you the breakdown of what can impact your credit score. I think it's very important for you to understand that damaging your credit score is far easier than restoring it. And damaging your credit score can also take place much faster than restoring it. So before you start taking on more credit, taking on more obligations, make sure you have a good understanding of what that obligation is and your ability to be able to satisfy it. Just because you may get approved for credit doesn't mean it's in your best interest. So here are the 3 quickest ways to improve your credit score. Our prior video told you what those things needed to consist of, but here are the 3 that'll give you the biggest and quickest bang for your buck. First of all, check your credit report and make sure there are no errors present. You are allowed to request a free credit report from any of the 3 credit reporting bureaus, Equifax, TransUnion, and Experian, to make sure you have no errors on there. Make sure there's something that you did pay off but it's not getting reported correctly. Check to see if somebody reported a payment being late, but it's really not. Make sure that they've got the right names on there. Sometimes you get people with similar names, or in a situation where you have a parent or a child that has a similar name to yours, you may want to check that and make sure that their credit history is not getting mixed in with yours. That's the easiest thing to do, and the quickest way to make sure you've got no troubles. Request a report and make sure there are no errors. 2, clear up any delinquencies. Look through the credit report and see if there are any delinquencies. Do you know of any late payments you have? Do you know of any payments out there that you have not made? You need to clear those up. Can you contact any of them and get back in good standing with them? Are these recent or long in the past? These may not be pleasant calls to make, but they need to be made. And 3rd, optimize your credit utilization. What we mean by that is that credit reporting agencies look to see how much credit you have asked for. Let's say the limit on your credit card and how much you've actually used. So if your limit is $3,000 on your credit card and you've used $3,000 and you have no buffer left, your utilization is 100%, and that's very high. The credit reporting company is going to look at that as unfavorable. Can you reduce that? Can you make some extra payments toward that balance so you can improve the utilization? Maybe instead of a $3,000 balance on there, maybe get it down to $1,500. Your credit utilization drops from 100% to 50%. Ideally, credit bureaus like to see utilization below 30%. Doing these 3 things could help see some results in less than 3 months. The longer term improvements come with time. Steady payments made on time, reducing and working to reduce your debt levels. Those are the things that have the biggest impact, but they take time. I know it seems like a funny thing, but in order for you to qualify for better debt, you need to show you don't need it. That's the world we're in. The time to do all this is before you need the debt. You need to get your act together, get your numbers together, get your payments in alignment, and make sure you have the best optimal credit score possible. So then, when you do need to borrow money, it's going to be at the most favorable rate for you. If you put all these things in place and you let some time lapse, you're not going to be feeling as though you've got your credit score and your personal financial ducks in a row. Maybe it's time now you consider making a purchase for a home. Maybe you're a first-time buyer. Maybe it's a different property. Maybe a second property. I don't know what the need may be. But after you've done all this, you may be in a position to start this process. Take a look at the blog that we have out there talking about is now the right time to buy. And it gives you some things to think about if now is the right time to buy a house. Take a look on the screen and get a chance and see what you can find out about that. We look forward to seeing you again.